Alphabet and Meta are offering millions to Hollywood to partner on artificial intelligence. Bloomberg reporting tech companies have held discussions over licensing content in order to create better video generation software. Disney and Netflix have denied the requests. Warner Brothers Discovery is still weighing a decision. Bloomberg's Alex Webb joins us now. I love this story, Alex, because it raises this question of, with all of the artificial intelligence models, and I want to go here before we broaden in specific to this story. How much are they relying on the content generated by humans in companies that are not benefiting in any way, shape, or form economically from what the output is from the likes of ChatGPT?
The risk here is, of course, that you get a little bit of money up front, but ultimately it could come back to bite you further down the line. It could also help you in a sense if you're wanting to generate, computer special effects, VFX, essentially, with this kind of stuff. But the complexity, of course, is that, yes, there are people in a lot of these videos. How are they remunerated? Are they getting additional pay from the fact that maybe their likeness is being trained on this? Presumably that's where some of the complication lies. From the OpenAI side, this is really about how do you find the next wave of data to train your next generation of, GPT-5 or whatever it might be called. Because the estimates are that GPT-4 was trained on about 1 trillion parameters, essentially 1 trillion data points. How do you find more? That's potentially the whole internet. So they're really in a search now to find new sources of data to get to that next level. And it looks as though video is going to be a huge part of that.
Data is one of the biggest assets a company can have when it comes to developing and training AI models, and no one can compete on data against Alphabet, a company that has lots and lots of data thanks to the fact that it's the parent company of Google. As a result, the investment banking titan, Goldman Sachs, hailed Alphabet as the leader among the Magnificent Seven when it comes to AI, and in today's video, we're going to explore why the bank is so bullish on Alphabet, as well as its new price target on the stock. Additionally, we'll talk about Alphabet's latest partnership with Meta, which is set to take down the streaming giants like Netflix and Disney. But first, if you want to keep up with Alphabet's latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market, so click the follow button if you do not want to miss the newest market updates. Now, back to the video. Bloomberg News' Alex Webb raised an important question in the interview in the beginning of this video, and that is, how can one person find a copious amount of data that could reach trillions? Well, the answer is simple: Alphabet. According to statistics, there are approximately 99,000 search queries processed by Google every second, which is nearly 8.5 billion search queries every day. Therefore, there's no doubt that the website traffic that Alphabet generates provides the company with more data points than any other competitor. And this is why hedge fund manager and Alphabet investor Bill Ackman cited Alphabet's substantial distribution moat as a unique feature for the company to sustain its lead in the AI realm. Using this large portion of data, Alphabet decided to team up with Meta to develop technology that can create realistic scenes from a text prompt, and have offered tens of millions of US dollars to partner with Hollywood studios in some capacity. On the other hand, OpenAI, backed by Microsoft, is having similar conversations with the studios. However, we know that OpenAI's data can't compete with Alphabet's, and this gives Alphabet the edge here. In fact, even if Microsoft allows OpenAI to access all of Microsoft Bing's data, it won't even come close. Bing generates around 900 million searches per day, and when compared with Google's 8.5 billion, that's an 840% difference. AI companies seeking deals like this isn't at all new or strange, as Hollywood studios are already using AI in production, and many filmmakers are eager to discuss ways to use AI to reduce costs. In fact, Tyler Perry has used the technology to recreate the makeup he wears for his Medea character in movies, and director Robert Zemeckis has deployed AI to de-age Tom Hanks in an upcoming film. However, there's still one crucial downside to this that could destroy all of these AI deals, and this is why studios are approaching these deals with caution, and we're going to go through that right now. So if you're an investor in any studios companies as well, like Warner Brothers or Disney, or a streaming company like Netflix, you don't want to miss out on this video. Hello everyone, and welcome back to Investocracy.
One example that's quite useful from the past is if you think about Toys R Us, I maybe don't want to push this too far, think about Toys R Us, and what they did is they went to Amazon, and Amazon distributed all of their toys. At a certain point, users then were going onto Amazon.com to buy toys, and the difference between Toys R Us and Amazon sort of blended away, and they were just buying toys on Amazon, and ultimately Toys R Us went under. That is the risk here, where if you are giving all of your training data to Google, and maybe there's a way you can get that back in return, it could ultimately come back to undermine your business. The details of it are going to play out in the next few years.
Hollywood studios are essentially trying to protect themselves from having their work stolen, as they are wary of giving films and TV shows to tech companies without control over how that content is used. We've all seen the drama between Scarlett Johansson and OpenAI unfolding over the past few days, as the actress asked the AI company to stop using a voice that sounded like her to power its chatbot after she refused to work with the company. Johansson isn't a studio's company or a streaming giant, but with that being said, companies like Disney and Netflix are not willing to license their content to these companies, but have expressed an interest in other types of collaborations. On the other hand, Warner Brothers has expressed a willingness to license some of its programs to train the models, but only for specific divisions, not its entire library. If Alphabet and Meta manage to convince the entertainment companies and pull this off, they're set to reap great benefits, as the American movie industry is projected to grow at a compound annual growth rate of 7.62% from 2024 to 2030, reaching around $26.92 billion. And perhaps we will see even a bigger number. So, early leaders like Alphabet trying to implement AI in the industry will have a very large piece of the pie in the upcoming years from the movie industry. With that being said, we have two renowned Wall Street firms, Evercore and Goldman Sachs, who are bullish on Alphabet stock, and Evercore analyst Mark Mahaney even shares his positive outlook on the company's future. So, let's hear his bull case. But first, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
Interesting. Okay, I like that perspective that you give. You moved Alphabet, by the way, in terms of your top picks list. You moved it up to number 3, right? And you replaced DoorDash with Uber. But tell me why you moved Alphabet up. Why'd you feel the need to do that?
Well, this is mostly bringing Dash down. Look, we made Google one of our top picks earlier this year when it just got dislocated for AI reasons in the wake of some of the product challenges they had when they first rolled out Gemini. But I just thought those were small little challenges. I think people I thought the call that Google was somehow AI roadkill, Gen AI roadkill, was way misplaced. And I think the company's proven that, by the way, in the last week. I think their I/O conference and then what they showed from Google Marketing Live 2 days ago, this company, I think, is a major beneficiary of AI. It's not just one. There's going to be 3 or 4 or 5 major winners off this. I think Google's one of them. And then I still like Google going forwards, and I prefer it over Meta because it's just a matter of product cycles and comps. You know, Meta had these great product cycles last year, and I think those product cycles now belong with Google. Like that's where the most interesting incremental product cycles are. And I think their ad revenue growth isn't going to decelerate in the way that Meta's will near term. So I like Google. It's one of our top picks. And valuation's still very reasonable.
As we saw in the video, Evercore analyst Mark Mahaney set a price target of $220 on Alphabet stock, which is an upside of 25.72% from the current trading levels. Additionally, Goldman Sachs analyst Eric Sheridan reiterated a buy rating on Alphabet stock with a price target of $195, which represents an upside of roughly 11.43% from the current trading levels. Sheridan said that Google's Marketing Live keynote outlined Alphabet's vision for its AI tools and services launch in the context of digital advertising. The analyst noted that Google continues to iterate on how AI can increase the performance of ad spend across Search, YouTube, Performance Max, and, increasingly, third-party platforms and inventory. Also, it appears from the research note that Sheridan remains constructive in the mix of Alphabet's business and operating profile in the coming years. So, with this in mind, is Alphabet stock a buy now? We can't deny that Alphabet stock is dirt cheap right now, as the company has the lowest forward price-to-earnings ratio among its Magnificent Seven peers. In our opinion, investors are discounting Alphabet's growth prospects, and the reason is largely rooted in competition. Sure, ChatGPT is extremely popular, and Microsoft has seen some impressive growth since integrating the AI tool throughout its ecosystem. Additionally, semiconductor companies will likely be a long-term beneficiary of the broader AI movement as secular tailwinds continue to push demand for chips. But all of this doesn't necessarily mean that Alphabet's business model is in danger. In fact, rising competition and booming use cases in AI could very well lead to a new chapter in Alphabet's growth story. Alphabet is extremely well positioned to benefit from several aspects of AI. As people continue to rely on Google and YouTube for sources of information and entertainment, Alphabet will remain as the leader in data collection. This should ultimately serve as the catalyst for the company's long-term AI roadmap. Therefore, this discount in Alphabet stock compared to mega-cap peers is a buying opportunity, and long-term growth investors should consider taking advantage of this. But what do you think about Alphabet stock? And what are your expectations for Alphabet stock? Let us know your thoughts in the comment section, and don't forget to tell us what your valuation for Alphabet is. If you would like to know more about the latest updates about companies like Alphabet, then go ahead and click on the next video on your screen.